Welcome back to Roadmap to Retirement Podcast. Today we have another Jarvis, Stephen Jarvis.
This is Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
We had your brother Matthew on a few weeks ago, and we figured we'd get the whole family in. You just informed me that there's 7 Jarvis siblings and that you and Matthew are the only ones worth talking to. Tell me more about that.
Why we're the only ones worth talking to? No, I fair enough. I have 4 brothers, so I'm used to some good-natured ribbing. No, my other siblings just happen to not be in the tax or finance world. So if you'd like to build a building or do some welding, I have a sister who's a music teacher. We cover a lot of things, but on the finance and tax topics, Matt and I have it covered.
Okay, that's fine. We won't. It's not a shot at them, but we'll stick with you and Matthew for now. And the reason I wanted to have you on is you're in this kind of CPA world and I'm in this financial advisor world. And of course, there's a ton of overlap in what we do. I spend a lot of time talking to my clients about tax planning. I'm not a CPA. I don't have that level of depth or knowledge that you would have. So maybe I know enough to be dangerous, but I'm curious to have your spin on things and what you think that clients should be thinking about in this tax planning world.
Yeah, Alex, I love that you take time to at least talk about this topic, because for not being a financial advisor myself, wanting to stay as a tax specialist, I really appreciate financial advisors who are willing to be that little bit of dangerous. And I know you say that a little bit tongue in cheek, but for someone who is managing a client's financial life, it's important to have at least a high level knowledge of the direction they need to go on a topic like tax. Because what I tell taxpayers, what I tell financial advisors, is that all of the planning that you do doesn't count until it's reported to the IRS correctly. And so I look at tax planning a few different layers. The top layer is really just making sure we understand what's going to happen at tax time, because every money movement has a tax impact. And so the simplest form of tax planning is just making sure we don't have surprises at tax time.
Yeah, that makes sense. I guess I should give myself some credit. I do know a lot about taxes, and I think that kind of in my wheelhouse, which is W-2 employees who are looking to retire. So if you're doing tax planning for somebody between the ages of 55 and 80, I know a lot about everything from the Medicare rules, Social Security rules, distribution rules, all that kind of stuff. And then I feel really stupid when I sit down with someone who's like a business owner and they're talking to me about their S Corp and their Schedule C and all this stuff that like I do for my own taxes, and I pay a CPA very well to make sure I don't screw it up. So there's a lot to know.
There is a lot to know, but I think, and really, you probably should give yourself even a little bit more credit, because you've actually maybe inadvertently stumbled upon the right approach to tax planning, which is get really focused on the things that are most relevant to you and let somebody else worry about the rest. So for the clients that you serve, you having a great understanding of what impacts a W-2 employee who is getting ready for or is into retirement, that's what counts, because the tax code's 80,000 pages long, give or take. I might be off a little bit, but that's the general idea.
You've read all of it, right?
Every last page, committed to memory. I fall asleep to it every night. For someone to do anything worthwhile with taxes, you have to be really narrowly focused. And so I actually take it as a positive sign when someone like you can say, hey, I don't know anything about all these other areas over here, but I'm good with this one area that I'm serving my clients in. That's going to create much better outcomes, because for most taxpayers, good tax planning comes down to consistently doing the simple things over time.
Sure. Yeah, no, that all makes sense. I think everybody needs to stay in their wheelhouse. Just like with accounting, there's things that you're very focused on. And I don't know this, but maybe like auditing is just not your thing. You had to know enough about it to pass the CPA exam, and you did that, it looks like. But maybe you don't have that level of competency that someone that does it every day does. And why would you?
It's a great point. And even within the tax world, there are areas that even as a CPA, I stay away from. I don't do international tax. If you're gonna wade into foreign taxes, you want somebody who specializes in that. I only do very simple real estate tax issues. If you have a rental property, I'm your guy. If you are investing in multiple commercial investment properties and doing 1031 exchanges, you want somebody who specializes in that.
That all makes sense. I thought we might talk a little bit about the landscape of our different professions. I think we went back and forth on LinkedIn about this debate. You were talking about how the CPA designation is making some changes so that they're not having the same educational requirement anymore. So forever, as long as I've been around, it's been that you need 150 credits to sit for the CPA exam. Is that no longer true, or they're just talking about making that change?
We're in the middle of this transition. And so for people who haven't recently been focused on this area, 150 credit hours for most people translates to a master's degree. Now, a lot of people will double major, or just honestly, what a lot of people do is just take silly classes. I literally worked with someone who took a belly dancing class to get to their 150 credit hours, which is part of the argument. But in large part because there is higher and higher demand for accountants and fewer people getting to increase that pipeline. And so there are some states who have already changed that requirement, because at the end of the day, you get licensed in a particular state. The CPA is different than being like an attorney. If you want to practice law in multiple states, you have to sit for the bar exam in each state. As a CPA, once I'm licensed in my home state, in general, this is a kind of oversimplification, but I can practice in just about any state. And so some states have started changing that requirement.
Okay. What's the easiest state to become a CPA in?
That's a really good question. I got licensed almost 15 years ago. And at the time, I sat for the exam in Colorado, which was one of the last states to bump up to the 150 credit hour requirement. So I actually sat for the exam with 120 credit hours, which is a bachelor's degree. And so I don't know which one is currently, we'll use sarcastic air quotes, the easiest to get licensed. It's pretty consistently viewed as one of the harder exams to pass.
Yeah, there's definitely a shortage. I've noticed it even so, like for myself, if I have somebody ask a question about their taxes that I can't answer, I refer them out. Just like if somebody wants to have someone file their taxes for them, I don't do that. So I refer them out to a network of CPAs I have locally and not locally too. There's a lot of remote ones, but it's been harder that I try to send a referral to a professional, and I'm getting a lot of CPAs coming back and saying, hey, I'm not taking clients right now. So like from that optic, it seems like there's obviously a shortage coming into the business. And I think my industry is similar. There's not enough people getting into financial planning to work with all the people that need help. So very broadly based, like how do we get more people into these two industries? What is your answer to that? You have your magic wand moment.
Yeah, if I had my magic wand, and the very first thing that comes to mind, and I haven't spent a whole lot of time trying to put together a game plan for this, but the CPA industry in particular needs better transparency of what career paths look like within accounting. I don't think the profession as a whole has done a great job of showing people why they should get into this profession. I didn't know anything about careers in accounting until I took my first accounting class at a community college because I thought I had to. And then I looked around the room and was like, oh, this seems really hard for everyone else and it seems easy for me. And then I started looking into jobs, and I think this is true of a lot of CPAs. It was originally a very practical decision for me. It's, oh, someone else will sign my paycheck. There's tons of job security. Let's go do that. And then I worked at big national accounting firms, which when you're in college, you're told that's the only way to be successful as a CPA, is that you have to go to one of these big firms that unfortunately do emphasize the grind and how many hours you put in and just putting in your time. It was only about 4 years ago now that I decided I'd try something different and start my own company.
Okay, cool. Yeah, I've got a friend from high school actually who went down the CPA path, got his CPA, and he was working, I won't name the company, but one of the big four companies out of New York. And he lived in New York City, and he paid back then a stupid amount of money for rent every month, and he just hated it. He burned out in 18 months, decided he wanted nothing to do with accounting, and now I think he does like some kind of software engineering type of thing. So totally burnt out from the career. But like to what you're saying is, if he had seen different types of accounting and different settings to have an accounting career in, it might have worked out differently.
Yeah, I think some of it's a perception issue. Honestly, I think AI will really help the accounting industry, not because it's going to replace accountants, but it's going to get rid of a lot of the more administrative and data entry type work that burns out a lot of accountants and lets people in the profession just do the higher level things that are actually more fulfilling and enjoyable.
Yeah, you're seeing that already with even just TurboTax, like some of the lower level returns. It's not people like you doing it, it's just the software does it. That's probably a good solution for those people. And it opens up time in your calendar to work with the people that need more hands-on help. So I think that's good. I'm curious to see how far the AI thing goes. I don't think that you and I are going to be out of jobs anytime soon, but I've been wrong before.
Yeah, I'm not concerned at all about job security. I've told people for years that even if the tax code went away tomorrow, which has been proposed this year, I don't think that's what is going to end up happening, but there's at least headlines around it. But even if the tax code goes away, at the end of the day, the way I add value to my clients isn't really specific to the tax code. It's specific to problem solving and relationship building and helping people navigate complex situations. And so I can apply those skills somewhere else.
Yeah, that's It's true. What would you say is like your ideal client in today's? It's much have evolved over the last 4 years, but who do you primarily serve?
So my approach is a little bit different than your typical CPA because I only work hand in hand with financial advisors. So for this 2024 tax filing season, as far as getting 2024 tax returns done, we'll do about 550 tax returns, but every one of those clients we work with also has a financial advisor. And so my ideal client is someone who's willing to take a long-term perspective because we want to do planning, not just preparation. They have a financial planner who's looking at the rest of their financial picture so that the clients aren't coming to me and saying, hey, Stephen, what should I invest in? Because I have no idea. That's not my area of expertise. And then I'm also looking for people who are willing to be proactive and lean into the relationship. I'll be the tax expert, but you have to tell me about your life. You have to tell me when things are changing. You have to tell me when things come up that I need to know about.
Yeah, that's true in our industry too. And it's one of my favorite examples is I'll have people that I'm a little embarrassed to say this, but they are clients on paper, right? Like they have an
Uh-huh.
account that is with my firm, but they never lean into the process. They go ghost a little bit. And then to no fault of my own or my team, like we're reaching out proactively. They're not answering their phone. They don't respond to emails. And then all of a sudden, out of nowhere, after not talking to them for 18 months, I get a phone call like, oh yeah, hey, I retired 3 months ago.
Yeah.
So you didn't think to talk to like your financial advisor about retiring before
Before
you just
that.
did it? Okay, that's fine. And it's strange because they're willing to pay for our services, but not part of it. Weird.
Yeah. Yep, that's a big thing on the tax side too, is if the year's already turned over, if you've already completed the transaction, there's usually very little we can do in retrospect. We've got to know about these things ahead of time if we want to proactively plan for them.
Yeah, we get a lot of people on the tax side of it. And again, not my wheelhouse, but it'll be, we'll call it a couple in their 40s and they're both W-2 employees. They've got a couple kids, they got a house, whatever. And they go to file their taxes. Is there anything else I can do to lower my taxable income? And you're like, as a W-2 income, you're strapped, right? Like they're already maxing out their retirement accounts. They're probably taking a standard deduction. They get the child tax credit, but there's really not a lot that they can do. So then it becomes a long-term perspective of, okay, let's accept that we can't really lower our taxes much today.
Yeah.
2025 is what it's going to be. But can we do something so that way down the road in retirement, you are in a better tax situation? Is that sort of the right approach? I'm just rambling now.
Yeah, for people in their high earning years, especially if they're not business owners, and I don't say that to mean that being a business owner is this glamorous thing that has all the answers. It comes with its own challenges, believe me. But yeah, tax planning should really be about minimizing your lifetime tax bill, or really the tax bill over the lifetime of your wealth, not in a given year. And so it's those simple things consistently over time. It's, hey, do we add in backdoor Roth contributions? Would that make sense in this situation? Do we strategically look ahead to say, when are those years going to be when you're at your peak earning, when you're at your lowest earning? Are there things we can strategically do between pre-tax and Roth accounts? But for the most part, for the vast majority of taxpayers, it is about little tweaks at strategic times.
Sure. Yeah, I think the backdoor Roth is one of the. Is that the best kept secret still? Can I even say that? I feel like everybody knows about the backdoor Roth, but I don't see the end client executing it as often as they should. I hear a lot of people saying, "Oh, like I was contributing to Roth, but now I earn too much, so I stopped." And they didn't have to do that. So let's talk about that. But it seems like there's something lost in translation between people understanding it's an option and people actually executing it correctly. I don't know if you see it differently from your view.
Yeah, backdoor Roth is a great example of how the internet can have all of the answers and none of the solutions. Because if you go and Google backdoor Roth, you can still find plenty of information out there that says it's not allowed, that it's not a valid strategy, that it was created by accident, which that's true. It was created by accident. But I've now been through multiple IRS audits where the backdoor Roth comes. And the IRS doesn't call it a backdoor Roth contribution. They talk about it as an after or non-deductible IRA contribution that was then converted to Roth, which is way too long to say. But the strategy, when executed correctly, the IRS blesses it every time because that's how, accident or not, that's how the rules were written. But there is a lot of nuance to getting it done correctly. And it's to your comment before about finding out about something after the fact versus ahead of time. If we go into a backdoor Roth contribution with someone to guide us through it and we have a clear plan for how to execute it, we can execute this thing the way it needs to be done time after time. It's not a gamble of, hey, is this going to work out right, if we have a good plan. But there's so much nonsense out there, and there's so many horror stories about people who did this so terribly wrong because they didn't have somebody to help them, that it scares a lot of people away.
Yeah, I think the biggest thing that we see when, in terms of not doing it correctly, is when people have another IRA and they're not aggregating it correctly, and then they get just the mess that goes along with that. And I think that's actually one of the biggest conflicts of interest that exists in the financial advisor world is if I get paid on an AUM model and I say, let's roll your 401k into your IRA, now that backdoor Roth isn't as neat and clean and buttoned up. Whereas if you roll that 401k into a different 401k, or even just leaving the plan where it is, which is usually an option, now you can do your backdoor Roth and it's a lot cleaner. So I think, our industry needs to make a better effort of being transparent about it to make your industry have a simpler and more straightforward job of reporting that and not getting audit messes.
Yeah, we call that the pro rata rule when there's other IRA dollars out there. That's a big one. The other one is that people misunderstand that there's actually multiple steps in the process, that you have an IRA contribution and then a distribution that turns into a conversion. And so sometimes steps along the way will get missed. And then the tax reporting. There's this lovely form 8606 that has to be completed correctly any year we're doing backdoor Roth activity. And we see that get missed all the time.
Yeah, that's definitely a thing. I think I asked you about a magic wand wish earlier. My magic wand wish would be just getting rid of the income limits for Roth IRA contributions, because who are you helping? It's people that are very financially savvy are doing backdoor Roths anyway. Like, you're really not eliminating it as an option for anybody. And if a billionaire, like if Elon Musk wants to put $7,000 into a Roth IRA, let him. It doesn't matter. It's such a small dollar amount. Like, when you're worth hundreds of billions of dollars, we're going to worry about $7,000. Who cares? So I don't know who we're helping. Maybe you know something I don't. Is there a reason that the income limits are there in the first place?
So, Alex, one of the things I repeat dozens of times every tax filing season is that we have to stop looking for logic in the tax code, because it will drive you insane. If you look for the reasons for tax rules, it will drive you insane. This is going to sound overly cynical. I'm just trying to embrace reality. Tax rules are the tax rules are made up by politicians, and then the IRS has to figure out what the heck they meant. And then the CPAs and enrolled agents out there have to figure out how that goes on a tax return. Yeah. And so you have all these convoluted steps to get to what happens in reality. But when the politicians started, regardless of what your political affiliation is, it happens on all ends of the spectrum. They are creating tax rules to drive votes.
Yeah, that's definitely true. I like to talk about that when I do a seminar series, and there's always somebody in the room, an older person, that says, what if they take my Social Security away? And my immediate answer is, that's not going to happen. Do you know why? And they look at me like, why? I'm like, because guess who votes? Senior citizens that are collecting Social Security show up to the polls, so neither party will ever take your check away, because that's suicidal. What they might do is take my check away in 40 years, but my friends don't vote, so who cares?
I do like to make that joke of if you're worried about them changing the Roth rules, you need to go recruit more people to get into Roth accounts, because the more people who have Roth accounts, the less likely they're going to be to change the rules.
Yeah, no, that makes a lot of sense. It's one of the other things that, to your point about politicians making rules and figure it out later, and I don't even know the right answer to this right now. So the Secure Act 2.0 made this rule about we got this 10-year spend down thing for inherited IRAs. Yep. And then a couple years go by and someone raised their hand and said, does that mean that I don't have to take any distributions the first year if I don't want to? Do you know the correct answer right now? Do we have an official rule?
We do have mostly official rules on this. There's still some edge cases, but the general idea behind it, this is for non-spousal beneficiaries. The general idea is that if I inherited an IRA, not from my spouse, I have 10 years to distribute the entire balance. Correct. Whether or not I need to take distributions throughout that 10 years, whether or not I'm required to, is based on the age of the person who passed away. So an oversimplification would be, if the person who passed away, the decedent, if they were taking RMDs, I have to continue taking RMDs, required minimum distributions. Alex, what gets lost in this conversation, though, is that a lot of people ask that question wanting to have as long as they possibly can before they distribute this money. In most cases, even if you were just to evenly distribute the money over 10 years versus take it all in 1 year, you can save 5 and 6 figures in taxes because of how our progressive tax rates work. And so what I really encourage people to do is not look at what am I required to distribute as a minimum, but what should I be distributing to take advantage of those 10 years?
Sure. I think where we see it as like a planning opportunity would be if I inherit money from my parents. Let's say I'm 60 years old. I plan on retiring at 65.
Yeah.
Inherit the money. Rather than spending any money in the first 5 years, why don't I wait until year 6 when my salary's gone away and then take distributions, hopefully in a lower tax bracket? And I think that's where the planning opportunity is, but it depends on, to your point, whether or not my parents were already taking RMDs, which if I'm 60, I hope they were taking RMDs. I probably have to.
Yeah. Yeah, Alex, you're taking the right approach. It's what do I know is going to happen in this 10 years? And does it make sense to wait 5 years? Do I do as much as I can in the first few years because I'm going to hit RMDs on my own accounts are about to kick in, and so I need to get this stuff out of there. It's understanding what that 10 years look like in that specific situation.
Yeah. And I guess even if you are taking RMDs, it doesn't need to be like 10% of the account balance. You would go to the table and you would take out your 3.5% or whatever it works out to be.
And that's the other nuance there, is whether or not I take RMDs is based on the age of the decedent. How much the RMD is based on my age. So if I were to inherit an account right now, as I close in on 40, if the decedent was already taking RMDs, their RMD would be significantly higher at age 73 than mine at age 40. And so I have to keep taking it because they were, but the amount gets adjusted.
I would love all this. It's amazing that people get confused, right? Like, how are these people? It keeps us employed. Even just the RMD age, they keep moving it around and making it confusing. I don't even memorize that. I got a table printed off, and I point to it.
As you should.
Born this year, you're after 1960. Okay, you're 75, but that's confusing to the average person that doesn't do this every day.
The other thing that is really confusing to just about everybody is percentages in general. So I've switched to, instead of talking about as percentages, I tell people how much it's going to be in dollars per $1,000 of their account, because percentages are just not how our brains work. Even for numbers people, we struggle with percentages off the top of our head.
Okay. I do prefer the percentage more than the like age factor, like dividing by 27.6 or whatever isn't intuitive to most people.
No, so to your point, I have a chart. I'm not doing it in my head. I have a chart that says, okay, at this age, for every $10,000 you have in an IRA, you're going to distribute. And then I don't know the numbers off the top of my head, but my chart tells me. So I'm not telling them the factor either. I'm not saying 27 and a half. I'm saying you have to distribute $2,750 or whatever the amount is.
I like that. I might steal that. I'll make my own chart.
Please do.
Cool. Love that. Okay, so we covered my magic wand wish. Do you have your own magic wand wish? If you could change one thing in the IRS tax code?
There's so many that I would want to change, Alex. I'm not sure that my magic wand doing ones is going to make any difference.
Okay, that's fine. How about instead of a magic wand, then a crystal ball? So what changes in the next 10 years to the IRS tax code?
So I have a crystal ball. It is very broken.
Okay, if you're not watching the video, we do have a crystal ball. Love it.
If I had to guess right now, and again, it's not going to do you any good to hold me to this, it's not going to hold up in court. My guess right now is that a lot of the Tax Cuts and Jobs Act provisions get extended, and we're looking at a similar tax rate environment for the next several years. 10 years ends up being the magic number because that's how they can get through a budget reconciliation process without going too far down the Congress rabbit hole. And then we see the same thing every time there's a change in administration of, okay, what is my voting base most excited about that's going to drive the most votes for my reelection?
Yeah, that's all about getting in office and staying in office, right?
Yep.
Cool. I'm through my agenda here. Do you have any questions or things that you want to make sure that our listeners are aware of?
Alex, I think we've already touched on this, but the theme that I try to really reinforce is that where most of us are going to get the furthest ahead on taxes is by doing the simple things consistently over time. That means we have to think about taxes more than just once a year. It means we have to be proactive, asking some questions. It also at times means that we've got to be a little bit okay paying a little bit more in taxes now so that we don't have to pay as much in taxes later. But the more proactive we can be, the more we increase our chances of minimizing our lifetime tax bill.
Cool. Love it. And before I let you go, so we talked about this before we started recording, but people that are watching this are going to think I'm crazy for not asking about all the medals hanging behind you. So you are an avid runner. You do Spartan races. When's the next race?
Yeah, so as we record this in February, my next race is in March. My calendar's covered up here. On March 16th or 17th, it's a 10K. I'll do a half marathon in April, and then I go back to Spartan races in May.
Okay, cool. Love that. Good luck with the Spartan races and everything else. Thank you for doing this. We appreciate your time. And this has been the Roadmap to Retirement podcast. All right, we did it.
Perfect. Love it.
Perfect. Thank you. Appreciate your time.
Yeah, happy to do it. Anything else I can do for you, Alex?
No, I was telling Matthew I'm interested in your conference in September, you said, right? So I'd love to hear more about that as information comes out. I know it's only February.
We've got a partial agenda we've released. I'll forward you an email with a link and then some of the details on what we've already announced.
Okay, cool. I love any excuse to get out of Rochester, so it's warm there.
It's gonna be great. Come on out. We'd love to see you.
Sweet. All right. Thank you. We will. So I think this is going to be next week's episode. So this will be released at the end of next week. Madeline, who you didn't get a chance to meet, will send you an email with some info on it. We, as you've seen, post a clip on LinkedIn. So it'll be like a 90-second clip that makes us both sound really smart. Perfect. If you don't mind hitting the share button and just getting it out to your network, that helps us.
Yep.
If there's any other segment of this that you want for your own marketing purposes, let me know. We're happy to share all of that. Okay. And I think that's it. Do you use any other platforms for business? Do you use like Instagram or Facebook or any of that?
Nope.
All right.
I can barely convince myself to be on LinkedIn, so that's where I stay focused.
I hate social media, like at the core of me, but
Yep.
I've been convinced to try to use. So I do.
It's super effective. Like I've created tons of opportunities out of LinkedIn, but I don't love it.
I've warmed up to it, but it's just it doesn't feel natural to me. But I've met a lot of people like you, so it's working.
Yeah. I appreciate you reaching out and getting this done, and look forward to the next time we have a chance to connect. And I'll send you that information on the summit.
Okay, awesome. Appreciate it.
Thanks, Alex.
Thank you. Bye.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.